Alrighty, folks, I am excited to break down some brand new research that's really going to help us understand what is happening at the Fed, what happens when they make adjustments, what kind of happens to assets, expenses, all of this. This is going to be called the fourth rate turning. This is going to be a lot of exciting information. And of course, we have Ulysses, awesome, with us. How you doing, buddy?
I'm doing well. Thanks for having me back.
Man, I love having you here. You're bringing in a whole new voice, a whole new level of research and depth. I appreciate you coming back. But, dude, I think before we get into the fourth rate turning, we'd be remiss if we didn't at least casually talk about the Southern California fires and what you and I already seeing from the ridiculous vultures that are circling, because it will have impact on rents and home values and transactions and all of that. So what are some of the things that you've seen already?
Yeah, well, just this morning, some of the increase in pricing on monthly rentals or short-term rentals, talking about thousands of percent increase, basically from last week, which there's surge pricing and then there's just
vultures.
I wouldn't want that karma coming back at me, to put it that way.
Yeah. Vacancies in Southern California are very quickly going to go to near zero, because guys, I don't know if you understand what happens when you lose your home to fire insurance. The insurance, again, assuming you have decent coverage, they're going to put you up somewhere else and they're going to pay for it. Right.
Right.
So, we've heard numbers of 12,000, 15,000. I don't know what the number is going to ultimately end up being, but there's going to be a lot of vacancies or there's going to be a lot of people that need housing, which is going to take the vacancies to nothing. I mean, James Wood, famous actor, shared a story on his feed about a house that was renting for $18,000. I mean, first off, good God, what kind of house has to rent for $18,000? But lo and behold, because the lease wasn't signed, it's now $30,000. I mean, that's 75% increase is ridiculous.
That's crazy. But that's probably just two examples. If we're seeing it, it's already happening on the ground for people.
No, I mean, it's gonna, but this will have implications not only for the week, the month, the quarter, the year, but years coming down the line, right? It takes years to build in California. Yeah.
Right. And they have a whole different set of issues than most places do as far as permitting goes, construction regulation. This is not going to be a fast fix.
No, by one estimate, it's going to take a decade.
Yeah.
And that's just, I mean, that hurts my soul to think about a decade.
Oh, absolutely. I lived in Los Angeles for a while. I love LA. It's unfortunate to see this happening, and there's a lot of economic consequences that aren't being discussed either, right? It's not just homes, but there's people jobs are being affected.
Yeah.
I had mentioned, just yesterday on a football note, the Rams game having moved to Arizona. Well, there's going to be a couple thousand stadium workers that they don't get to travel to Arizona to work the game. They're just out of their last game of the year's paycheck. And that's just, one minor part of it, but there's a lot of people whose daily lives are disrupted over this. It's not just the 12,000 houses and buildings that have been destroyed so far.
Yeah, and the other thing when you think about what this is again is what's coming. Vultures are coming, right? We can talk about the most recent things with rent because that's like in your face and immediate. But let's be very clear. There is going to be some vultures coming in trying to scoop up land for pennies on the dollar.
Oh, right? Absolutely.
And there's going to be a lot of people taking advantage of folks that frankly probably don't have options, right? The Palisades, the average house I've heard is or I guess it'd say average or median. I guess it doesn't matter. Call it $4 million. Sure. There are people that have lived there for 40 or 50 years. They bought it when it was, I don't know, $100,000.
Yep.
And there's no way they could afford it at $4 million, but given Prop 13 and some other things, that they could still live there.
Yeah, that's going to be an interesting thing to see going forward too, isn't it? What's going to happen with real estate taxes being reset at current values for people that are building a new house, and then that resets their property tax value.
Oh, can you
What's
imagine?
going to be the effect? That could be an enormous shock for Los Angeles.
It'll be
And then,
we're going to have a lot of forced sellers because if that happens, and again, they could always sign some executive order or something, make all this go away,
sure,
maybe. But again, when you go out and you rebuild a home, it gets reassessed. That's just
right.
that's just what happens.
Yeah, oh, absolutely. And so there's implications not just for those folks there, but also the city of Los Angeles for their tax revenue in the county and how they're going to deal with that. And they're already struggling with budgets. It's
Yeah.
already well documented. They cut $17 million out of the fire department budget.
Whew.
So you're
Yep.
talking about a political and economic firestorm, literally, because of this. It's
Yeah.
really
Yeah.
it's a bad situation.
Yeah.
And the other part that I have yet to see anything about, and maybe it's not going to be as much given the areas that are being publicized about the fires, but their rent control. What's going to happen if any of those rent controlled units wind up being rebuilt? And you're going to see a lot of rents reset again
Of course.
to market rates. So there's really a lot of potential factors to think about what's going to happen in Los Angeles.
Yeah, and the other thing that we have to realize is the current estimate. I don't know if you saw it this morning. Is now ballooned to $150 billion.
Yeah,
Right?
that's a lot.
California insurance, even Cal, what do they call it? Cal Fair or something like that.
Right. The
What?
state-backed insurance
Yeah,
program.
it doesn't have the money. It doesn't have the money. It's
Yeah.
not there.
Add on to the woe, right?
Yeah.
It's really a potentially terrible situation that, I mean, for the whole state, not just LA. To your point, how are they going to fund that? Who's going to pay for it? What's the situation going to be? There's a lot of questions out there still. And I think as of this morning, fires are less than 20% contained. Am I wrong? Or
No, I
so,
think they are. I think they're still threatening Brentwood and some other very
right.
well-to-do areas. It's horrible. I guess the last thing to talk about this, and then we'll move on to the fourth rate turning, which is really supposed to be the meat of this conversation, is I think about real estate. I'm thinking about active inventory and what might
Sure.
happen to prices. And again, it's going to be very distorted, right? There's
Yeah.
going to be less active listings, just mathematically, and you're probably going to see a lot of people come in and just buy a home because again, what has happened in this occasion is lots of rich people have been displaced, and they have the
Sure.
capital to say, hey, I'm going to stay here, I'll buy that other house, and I'll wait for my other one to be rebuilt. So we're going to probably see some very distorted prices on assets in
Yes.
Southern California.
The tug of war, basically,
Yeah.
between multiple different groups that force selling, to your point, and those that are going, yeah, no problem. Here's the cash, or here's people that have funds set up ready to go.
Yeah. Yeah, I think it's going to be real because I just playing with this. I think it's going to be a tale of two tapes. There's going to be the perfect, ready move-in condition house, which will fly off
Sure.
the shelf probably for higher prices. And then there's
Yep.
going to be the distressed land value, which people are just going to land bank. That's what's going to
Oh,
happen.
yes.
Oh my God.
Right.
They're just going to pick this stuff, land bank it for a few decades. And oh, this is going to be so bad.
I had read an interesting take from somebody out there about the coastline, the PCH properties,
Oh, those will not
on
be
the
rebuilt.
on the actual beach side, about how a lot of those just may never be built again.
Oh, they won't be built. The Coastal Commission, those will,
Right,
that's just not going
that's
to
a
work.
legitimate potential reality.
Oh yeah, and those owners got to be compensated somehow. That's got to be $1 billion stretch of land right there. I've driven
I would
PCH. I've
imagine. Yeah.
I've eaten at God. Why am I drawing a blank on the fancy sushi place or whatever? I've eaten at some of those restaurants, and
Yeah.
yeah, they're not coming back. The ones on the left side as you're driving down,
Yep.
those aren't coming
Yeah, on
back.
the actual coastline. I mean,
Yeah,
and then
Carbon
that
Beach and all that
you're
stuff.
talking about what a loss there too, right? Somebody, for the people that had that property, not being able to rebuild on it,
Oh,
that's history at this
history.
point.
Yeah, absolutely. It's history. All right, that's enough. Let's get off that. It's all terrible. It's all going to be bad. We don't know what's coming, but the results will be bad and unexpected and slow and blah, 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 blah. Now, let's get to why we got together, right? We scheduled this call a week ago before all of this broke. You've created some research. You've done some. You've published some articles and all your research, which I thank you for, on something you're
Yeah,
calling the fourth rate turning. Define what
yeah.
it is, set us up, and then show us the amazing stuff you've done.
Thank you. So I wanted to look at the actual effect of federal funds rates cycles on the economy overall. And by the economy, I mean all different types of asset classes, performance, but under the guise of, if we keep doing the same thing, why would we expect different results? Uh, so the first step was really to break it down using the federal funds rate as a timeline.
Okay.
And so I've got up on the screen basically the timeline of the fourth rate cycle of the 21st century. So the fourth rate turning, meaning we're now at the stage of lowering rates.
Mm-hmm.
And I broke this out for the last 8 cycles, but the 4 of the 21st century, I've got these timelines. And each one of these, there's multiple different things that affect economics, right? Everything from Russia invading Ukraine, Prime Minister Abe being assassinated, all the way up to things like, PGA's merger with LIV,
Mm-hmm.
23andMe data breach. Because I think what is important to note is to really put some of the things that happen economically on a timeline,
Right.
and understand where and when they're happening, right?
Mm-hmm.
I think it's kind of glib to use that mania chart saying, right, smart money,
Mm-hmm.
mania, because I don't think there's always mania, and I don't think things are always a bubble. I think it's just the nature of how business cycles work. So this kind of puts it in different context of, where do things happen along federal funds rate cycles, and where is there softness? And so what I did is I compared the federal funds rates, right? Created a set of indexes. I call them the EFF cycle indexes. And I have indexed everything from residential construction spending to a number of construction units being built. I've indexed gold, silver, soft commodities, energy, and even the NASDAQ, Dow Jones, and S&P 500. And
Nice.
so every time we have the Federal Reserve begin to raise rates, if we index everything to that being our starting point,
Mm-hmm.
now we get a much different view of how the economy responds to rates raising, and without saying things like we have, the lag effect, but
Mm-hmm.
what is that really, and how do things perform?
Okay.
And so what I discovered was they perform really similarly across the federal funds rate cycles, no matter what point in the cycle things are. So we've got a couple different charts I can put up after this as well. But essentially, it's just a different way of saying, how are markets changing? Why are they changing? And just show where along the cycle we are.
Okay. So just so we can orient people what we're currently looking at, this is a timeline chart going back to, I guess that's March 1st of 2022.
Correct.
And again, that will be the fourth rate turning cycle where they started raising rates.
Correct.
Is that right? And then again, across this timeline, you've identified key moments, not an exhaustive
Correct.
list by any means,
No,
but
not at all.
you're highlighting things that rippled as this started. Is that correct?
Right. Absolutely. So
Okay.
one of the things that is fairly well publicized is the financial troubles that Hollywood have been facing. But this kind of shows you, back to July of 2023, the SAG-AFTRA strike really helped put a dent in Hollywood's able to create monetary value.
Right.
Shortly afterwards, Sony Pictures acquired Alamo Drafthouse, which from an antitrust perspective was huge, because that was something that the U.S. previously didn't allow, and had broken up studios in the past because they wouldn't allow them to own both the method of production and distribution for video.
Interesting. I did not know that. Okay.
So there's impacts there, and then you can see the effect on the restaurant cycle as rates, neared their peak, or the last sort of couple months before rates drop. Mod Pizza, which was one of the fastest growing pizza chains in the country, winds up selling for pennies on the dollar to a private company.
Mm-hmm.
So I've created these for each single timeline going back 99 to 2003, and then 2004 to 2011 would have been the second rate cycle.
Got it.
2015 to 2020 being the third rate cycle, this being the fourth rate cycle, and we are now into 2025. And one of the things I put on here, Department of Defense acknowledging New Jersey drone swarms. If you were to read the research, and this is on my website, thememo.net.
Okay.
It's free for anybody that wants to look at this. But each set of these cycles has a correlating component of government spending, and then sort of NatSec industry changes as well. Just as an interesting point, you and I have talked about. What are some of the things that legislators do in order to spur the economy, or how do they save the economy, as they put it?
It's going to be really interesting, because I love the fact that you broke down all 4 rate rising and cutting cycles into timelines. By having them in separate views, you can really start to see the similarities, right? Like Mod Pizza, for example. You're probably going to see other fast-growing companies that over-leveraged, during the bottom get crushed as rates increase. Shocking. It's happened before. Right?
Right. And therein lies sort of the interesting part about it to me is, if we look at it under the perspective of when rates rise from, so basically trough to trough, well, that's a pretty clear example of a cycle in and of itself.
Yeah.
Federal rate cycle, but how do businesses respond to that? And amazingly enough, when we repeat the same behaviors, we tend to get the same outcomes, or similar outcomes.
Yeah. I'm so glad you did this, because it's hitting me now. One of the things that I did, I think it was 3 years ago, the first time, I created a 50-year spreadsheet of like 25 different assets. And the reason I did that is I wanted to go back and study the early 80s. Because again, I remember thinking, hey, Jerome Powell just said pain is coming. What might that mean? So again, I don't expect things to be exact, but it was the reason I was right when I called a transaction crash, but not prices. And dude, I got shit on for that. I got freaking hate. I mean, people looked at me like I had 3 eyes. I'm like, guys, this happened before. Why are you freaking upset with me? Just because I'm telling you what happened last time. Yeah, sure, this time could be different, but hey, morons, we just raised interest rates 900 basis points. Don't you think something similar?
It's going to have an effect, right? When we've seen it before.
Oh, my dude, I got so much hate. Because everybody was saying, no, stupid. If interest rates go up 1%, prices have to fall 10%. And I'm like, no, they don't. That's not what happened last time.
It's an interesting phenomenon, isn't it? When we get the same thing happens and we expect a different outcome. But to your point, we've seen that movie before, and you saw the volume crashing, and we had extremely low volume in 2024 for transactions. To your point,
got it right. I got it right. All those haters that were all over me for a couple of years, you were wrong. I was right. All I got to say. Take that.
So I put up the third cycle. So this would be 2015 to 2020.
Look at that. This is so awesome that you did this.
And so this, again, you can look at different, right? We've got sort of the early stage of the cycle, Amazon acquiring Whole Foods. We've got S&P drawdown beginning in 2018. And again, I look at, stock markets, I don't look at it like it's always a bubble. And I think you and I can understand this from a real estate perspective. You should always pay less, right? And we've talked about that. You make the money in the buy. But that doesn't mean that that's how everybody operates or behaves. So
I would tell you, let's be very clear. I think most people don't operate that way. I think most people chase momentum. Most people buy off emotion. And that's why I keep saying, guys, go get a buy box, look at the buy box, stop shiny objects, write disrespectful offers. Real estate investing, when done right, is work, but not hard. I mean, it's crazy.
Absolutely. So then we've got the second one. And then, I even called out some of the early troubles prior to GFC. We had a hedge fund shut down.
I remember that.
I love this right at the tip top. Bernanke says subprime is contained. how fitting is that, right?
Oh, yes. Yeah, that was wrong.
And then I also included some fun things in here because I like to reference things that happen in pop culture, like the Bourne Ultimatum being released,
Oh,
because I think it helps people that have lived through
yeah,
these
remember,
cycles
right?
sort of,
Yeah.
yeah, put in context when things happened and where they were.
Oh, I think
And of
that's a
course,
good
remember,
move. That's a good
look
move.
at the downside on the federal rates here. I mean, all that carnage, Bear Stearns, and then of course we've got all of the different stimulus acts, all
Mhm.
on the downside
Yeah.
of the federal rate cycle. And then same thing, right? First federal rate cycle, obviously .com bubble, as we call it,
Yep.
broke right at the beginning, but we had a lot of problems after that.
Yeah, that's the one that smacked me. 80% of my wealth disappeared. I
Oh,
certainly learned the lesson
that's
about
terrible.
cycles from that one. Hey, looking back as a 50-year-old or 52, I'm glad it happened because it saved my ass in every other cycle. The next 3 cycles, I was well prepared for. That first one, dude, I remember saying I was smarter than Warren Buffett. How stupid was I? Dumb.
Hubris, right?
Yeah, hubris.
That's a good thing. We all learn from
Yeah.
situations, or at least
Thank
we
God it
should.
only took once. Thank God I learned it after once. Yes.
So I changed this up here. This was basically the first iteration, and this is the previous 4, right? So this is the index that I'm talking about. So you can take a look at. We've got 1980 to 1983, 83 to 86, 86 to 92, 93 to 99. Those were all those same federal fund cycles, and the
Interesting.
same reality is true for this cycle. Uh, it's 2 that are similar in positive direction, 2 that are similar in negative direction.
Hmm.
Um, so obviously, 93 to 99, there was a big growth in housing, but there was also a big growth in housing from 83 to 86 during that Fed cycle. And then, of course, 1980 to 1983 and 86 to 92 wound up building significantly less.
Yeah, that's interesting because you know this, but we'll bring the audience in. We get some housing data at the end of the week. I think we get builder confidence on Thursday, and then we get housing permits and starts.
Yeah,
I've got to imagine it's like the bottom 2 of these, not the top 2, is what's happening
sure.
today.
Well, it's interesting that because I have that and I can put some of these up here for you. I even, put together some stocks like
Oh, that's
Coca-Cola.
interesting.
You can see its performance,
During
based on
different
rate
cycles. Yeah.
cycles.
Huh.
Yeah.
And again,
Corporate
just so
profits.
where can people find all of this amazing stuff one more time?
Yeah, it's thememo.net. And it's under the title of the heading is the fourth rate cycle, fourth rate turning. Um, and
The
then, I've
memo.net.
included, yeah,
I'm
yeah,
just making a banner so people can type in it. Do I have it
oh,
right? The memo.net.
thememo.net. That's it.
Awesome. There you go, folks. Go get it. It's there. The amount of charts and data in this is going to be crazy. So go get it today.
And I thought you'd find this one interesting because you and I discussed commercial leading
We did.
residential.
Mm-hmm.
Take a look at the delinquency rate on commercial real estate in comparison.
I know which one that looks like.
Yeah, right.
2004 to 2011. Oh my gosh.
Yeah,
Yes.
not a good thing. And then to your point we discussed before on single family.
Yeah. It's just not there. The problem's not there, at least not in the short term.
Not yet. Yeah, and right now we're trending more in the 2015 to 2020 level on that direction. So
And again, it really does make logical sense, right? A lot of people, again, yeah, a lot of people have mortgages that are frankly affordable. They bought before and they have, rates below 4.
sure,
It's just affordable, right? They're not affected by the price increase, right? So their cost of
right.
living is relatively fixed.
Oh, absolutely, absolutely. This is one of my favorites. And I'd love to get your take on this because we've discussed
Mhm.
this before. The government's going to respond somehow to whatever weakness it perceives. And
Agreed.
so this is going back to 1970. Take a
Mm.
look at, again, not exhaustive list, but when some of these acts were put in place and why. And it's pretty comical as to where they show up on the federal fund cycle as a timeline, in my
Yeah.
opinion, or
Yeah.
very telling.
No, I agree. Yeah, I think it's, dude. In my opinion, the first 6 months of 2025, I've been studying the economy for more than 30 years, specifically the consumer for more than 30 years. And I don't recall a time where I was more, I don't know if I want to say confused or uncertain. I think the word is uncertain about
Sure,
what's going to happen January through June.
sure.
There's just so many cross currents, so many timing elements, so many things could break spectacularly, or we could have a growth spurt that we haven't seen in years. I just don't know what's coming. And,
Yeah.
and it's, as a guy who reads every day and usually has an opinion, shit, I don't know what's coming, man. It's wild.
I think the majority of the country's in that camp. I think everybody can see potential risks, but there's also the hope, right, that
Yeah.
things are going to improve. So, and then looking at some of the different data points, as we just showed, the current single family housing delinquency isn't in a position that is
Not a problem
concerning,
today. Yeah. I mean,
but
and
commercial real estate sure looks problematic. And
oh, and
right
I
now,
think it's worse. I agree.
yeah,
Yeah, I think commercial gets worse. It's really going to be interesting because I think a lot of people, when you talk commercial real estate, naturally think that any commercial real estate pain will ripple through to single family. And
sure,
I would argue the connection is tenuous. It's not direct. It's not immediate. Right? It's not like, hey, A falls, B falls.
yeah,
Because what it does is it turns, like, if commercial banking has a problem, we have a banking crisis, and there's 200 banks that disappear and yada yada, like, it goes horribly wrong.
yeah,
Residential real estate is somewhat inoculated, right? You've got this Fannie and Freddie organization out there focused on owner-occupied single family, and they're not going to be impacted. Like, we could lose 300 banks and home ownership, you know, the lending doesn't turn off, and I think a lot of
right.
people think it will.
The It slows, right?
Oh, it slows, but doesn't turn
You
off.
know, and it's overall, and I actually am tracking mortgage asset transactions too, right? So it's not just originations, but secondary markets.
Yeah,
Um,
how is that going? Because I don't see that. What's going on in the secondary market?
it's not going as well as it has. Our overall lending has significantly dropped. I'm going to end the screen sharing
Sure,
here and look
no problem.
for a different chart because I do have something that I think that,
Yeah, while you look for that, I got this from so one of my lenders comes on the channel, and they told me privately that the largest Wall Street firm that funded DSCR loans
yeah,
stopped buying DSCR loans in early December, and made
wow,
the call to not restart them because in what? So why would that happen? Well,
yeah,
it's very simple. They mispriced risk, right? They
sure,
were buying them at such risk. They all looked good when, Airbnb was rocking and rolling or whatever they were doing. And now people are getting smoked, and they realize that that's what happens in lending, right? You don't really see the pain of your stupidity for a couple of years.
right.
But now that they're out of the market, what is that going to mean? Well, that means DSCR loans are going to be less common and more expensive. Right? That's just how this business works.
Absolutely. Um, which points to also more pressures that we've got on loan rates for the next few months.
No,
Everything looks like
exactly.
that's going to continue rising at least for the first quarter. Um,
Yeah.
I don't see any way that it's not,
Here's a
or
crazy
why somebody
question
would
for you.
say, you know what, I'll take less spread, right?
Yeah,
And
no, yeah, the spread could go up. I mean, that would be a problem.
right,
One of the reasons rates aren't 8% today is because the spread came in.
sure.
Yeah, yeah, it's crazy.
So these are mortgage asset transactions.
And just so
Um,
we're clear, when you say mortgage asset transactions, for me and the audience, is this just residential or is this all?
so this right now is across every single spectrum,
So
and I
any
do
mortgage
break
anywhere?
correct, and I
Okay,
do
all
break
right.
these down based on 1 to 4 families, multifamily, commercial, even farmland,
Hmm.
and this clearly shows right with the GFC we've got it was
Yeah.
616 billion dollars in destruction of mortgage assets. And a mortgage asset, right? So it's not just an origination, but this is everybody that had held a note or a bond. That was the level of financial destruction in real estate or to
Wow.
mortgage assets from the GFC. And if you look at the commercial version, I've got another. I tracked that as well, and that's got losses throughout every recession. The 1990 to 1994, it was $125 billion in destructive mortgage assets, so bonds, securities. So that's bigger than just like price corrections, right? So it's not just 660 million in all real estate prices. That's like everybody's long-term bonds and securities tied to real estate. And that's through. So this is banks, insurance companies, GSEs, but private credit would not be included in this because that's obviously not reported the same way. The Federal Reserve Bank does actually report this data. I seem to be the only one that I know of that finds fascination in this. But if you look at it, right, this was our peak into 2022, and this is where we're at since. So the volume
transactions are down.
Correct. Transactions way down. The dollar level that we're transacting at is back to where we were in the late 90s. In commercial, it's the same dollar amounts that we were at in 1984. So that puts some perspective on
84.
Yeah, and that's right. We hear about the extending, right, modifications. We're hearing about commercial mortgage-backed security delinquency increasing.
Yep.
And that's part of, to your point earlier about transactions. The transactions are frozen, and we're at dollar amounts that we were last transacting at in 1984, October of 1984 to be exact, which on a quarterly basis.
Wow,
so it's really
crazy.
So as you can see, this is all transactions. Credit slows, transactions slow.
And what that really means for me is that you don't have why the reason why commercial real estate is broken to me is right here. We don't have price discovery. The buyers and sellers and lenders haven't faced reality. We've seen some of that unlock in what is called Class A. We're seeing that transact roughly 25% below the last valuation. But dude, Class B and Class C have not. And I would bet $1,000 that when it all comes to bear, Class B and Class C multifamily, it's the only stuff I know with any level of detail, could be down 40 to 50%.
Yeah.
It's coming.
Yeah. It's entirely possible. I'll show you just the multifamily version because I've got some dollar amounts on there as well that I think you'll find interesting. But this, again, to your point about multifamily, that's also something that we've seen in the past as well. Not just losses on the actual pricing of the asset itself, but also, again, on mortgage assets, bonds, commercial mortgage-backed securities.
It's funny you bring this up because that stuff. I have friends in the industry, and they're telling me there's actually some pretty big money buying debt right now. Right, the actual assets aren't selling. Like guys like me wouldn't be able to play, but there are asset players actively buying debt at significant discounts.
I think there's a lot of people looking for that as well. That's where transactions, might be happening. So here's NASDAQ cycles.
Man, look at all this data, folks. You got to go to thememo.net to get this because it's going to take you hours to absorb all this. This is pretty amazing.
And to your point about builder sentiment, so I even indexed the NHB cycle. So again, that one's real similar to the 04 to 11 cycle as well. Builder sentiment.
Yep.
Which I find fascinating. NASDAQ. There we go. Multifamily. So this is just broken out. These are just multifamily mortgage asset transactions.
Now, this, just so we're clear, this would be the asset moving from A to B. This would, for example, to an earlier point, not be debt being sold. This would be the actual sale.
No, so this is all mortgage assets, right? So that's
Oh, okay.
originations,
Got it.
that's securities, notes, anything tied to the mortgage itself.
Okay.
So the actual dollar amount losses on a sale would be bigger than this, right?
Yep.
Um, and
Okay.
these are not inflation adjusted, but this shows there was $21 billion in destruction in the GFC of mortgage assets for multifamily.
Mhm.
1990, we saw uh, almost $36 billion in
Wow.
destruction. Was part of the RTC that was disposed of.
You know what's
Used to
real
be
funny? I bet you if you were to ask most people out there, they would have thought incorrectly that the multifamily pain recognized in the GFC was bigger than the early 80s. And I bet you most people would thought it was double. And that's not
Yeah,
true. The RTC was worse. And that was
right.
because of some tax changes and all these other things. But
Yes, absolutely. I even call that out in the fourth rate turning, and I've got that some of those legislative changes that altered what was
absolutely.
happening to multifamily because that's again, it's one of those things where if you look at the economy from a perspective of if we're going to do the same thing, we shouldn't
Yeah.
expect a terribly different result.
Yeah.
And
If you change the tax laws so you can't, like, for example,
yeah,
they outlawed the ability to take depreciation.
correct.
That would have a massive and immediate effect on
Which it
all
did.
commercial. Yeah, exactly.
Yeah.
Of
Oh,
course it did.
absolutely. Yeah, it was enormous. And then they went, "Oh, whoops, now we've got to
Well,
pass diarrhea and clean
that's
up the
funny.
mess we just created."
Yeah. And
So,
again, folks, this is where people like Sam Zell, rest in peace, made his money. Sam Zell was a
yeah,
shark in the RTC.
yes. Oh, absolutely. I think that there's a tremendous number of real estate operators out there that have been at it for a long time. That is where they made their money from, is
Of
from
course.
picking up the pieces of the RTC and at basis points that were much lower than what people can imagine today.
No,
I talked that
yeah.
that's where most of the money gets made is on the buy.
Yeah. If you ever get the opportunity to buy a physical location for less than land value, probably a good buy. Just saying.
Yeah,
Probably.
absolutely. There were a lot of sales for a dollar back in the 90s,
Yes.
mid to late 90s. People were buying properties for a dollar.
Yeah.
The
I
cities
know
had
of.
stuff on tax rolls left and right.
Yeah, I know. I know a family in New York. Olivia and I are friends with. We've done trips with them and whatnot. They were buying buildings in Manhattan
Yeah,
for $1 during the '80s drug problem. $1
uh, in Manhattan, no less.
in Manhattan for a
Isn't that
dollar.
crazy?
So
And
again,
now
these,
we're back to
yeah, it's
we've
crazy.
got families that have had real estate there for generations. They're selling now in New York.
Yep.
It's
Yeah,
just a
it's just a
cycles.
cycle. Yeah.
Yeah,
Yeah. So,
crazy.
I know there's a lot of data there. Everybody should go through it, make their own opinions. But now that
Oh,
you've gone through
absolutely.
it, you've shared it. What are some of your thoughts on this fourth rate turning cycle? Because there's we may be starting another one, right? There are rumors. Bank of America actually hit this over the
I saw
weekend
that.
that
They might
rate
raise
cuts are
rates.
over, and the next move is up, not down.
Yeah. Uh, I don't agree with Bank of America on that. Uh, I don't think we're going to see more rate increases. I think we'll see more cutting.
This year,
How much?
25.
Yeah, I do. I do. I think the employment data that the Fed's looking at is a lot softer than what's getting reported on a daily basis. We
Sure.
have 2 million fewer full-time jobs than we did 2 years ago, uh, which I don't consider that a strong
No,
job
agreed.
market.
No, agreed.
Um,
Yeah.
we have the most amount of people working two jobs that we've ever had
Mhm.
since we started keeping track of it. And while we might have dropped 1.5% in unemployment rate, it's still elevated, and we still have elevated continuing claims. So I think
Yeah.
from the Fed's stated perspective of they're looking at labor softness now rather than inflation, that we will see more. And I
Okay.
think the more that they cut, the more we're going to have the same that we've always seen on the back end of the cycle
Yeah.
turning.
It's
It
predictable.
goes up, it comes down,
Yeah.
and we'll get more of the same.
Nice, nice. Good. It's really interesting. We do get a CPI report this weekend. I don't know if you've seen the projections, but they're kind of frightening, in my opinion. I
And I
would
saw
mention
the UMich expectations were
two
terrifying.
nine,
Yeah,
2.9 was the forecast.
would-
Last month was 2.7.
I think it's understandable why everybody will see it go up. I think everybody's so sick and tired of watching prices increase. They've gone, well, of course it's going to keep going, because how often do they go the other direction?
Yeah.
But the rate of change, I
expectation.
guess, will.
Yeah.
What's that?
I was going to say also, we saw earlier in the week the 5-year inflation expectations took a noticeable jump up, 3 and 5 years.
Right.
Yeah.
I guess it's going to be for the next quarter, this quarter. I don't see much.
Yeah, nothing
changing. I think we probably see some less growth in the markets than what we saw. I still think there's room for them to keep going up as far as equity markets go. My real expectations are basically the first half. I think the second quarter of this year is where we see the majority of the softness, at least looking at it from these Fed rate cycles.
Yep.
So if we get cuts in January and in March, then we're talking about we're further down that line of things falling apart, economically speaking. And if we have more increase in mortgage rates through the first quarter, well, remember, March and April are key months for home sales.
Yes, they
So if
are.
we see that or all real estate transactions crash even further, that's not a good sign for the economy, as even fewer dollars go out to work. And then we start to see, in my opinion, potential real economic damage, or maybe that's where price discovery becomes
maybe
a reality.
Yeah. So I just want to make sure I heard you correctly. You're calling a January cut. Did you say that, or did I mishear?
Yeah, I do think they'll cut again in January.
Wow.
Yeah.
Okay.
And if I'm wrong, but
I love guys who make calls.
They'll cut it.
Yeah. So you're thinking January and March. I did hear you correctly. We got
the
next 2 meetings. All right. I like it. I'm calling no cuts in the first half. And frankly, my base bet is no cuts all year. So that's where I've been for quite a while. So it'll be interesting. Because again, there's just too many unknowns, too many variables. I still think the December cut was a mistake. They should have kept that in reserve. But we are where we are.
I think it's an interesting spot, isn't it? If you're focusing on employment or if you're focusing on inflation, it's like a double-edged sword, and you lose both ways, in my opinion.
Yeah, exactly. Yeah.
More unemployment is not good, but also more inflation is not good for anybody either. And I don't know. I can tell you, I wouldn't want that job.
No, you couldn't pay me to do that job. This is amazing. Well, Ulysses, you put out a lot of great work. They can go get all of this at thememo.net. You also are very prolific on X and Twitter, which I had up earlier. I'll put it back.
Thank you.
Follow, give them a shout out. Any closing thoughts as we wrap this up?
I hope that I'm wrong, and the next 6 months are absolutely fantastic for everybody. Genuinely. I hope the situation in Los Angeles and California improves, and that whatever comes out of this is a net positive for the citizens and the economy there, because I know that there's a lot of folks there that want some changes, and this might bring about some hopefully positive changes.
Love it. No better way to end it than there. Thank you, Ulysses.
Yeah, thank you. Always a pleasure.